Welcome to the latest episode of Renovating Retirement with Charlie Jewett and Bobby Alford. This show confronts the retirement planning industry and reveals all of the tricks, lies, and scams the stockbrokers, insurance agents, and financial advisors use to steal money from consumers. In addition, Charlie and Bobby will teach you everything you need to know to make your own financial and retirement decisions and live the retirement of your dreams. Now here are your hosts, Charlie and Bobby.
All right, welcome back to Renovating Retirement. This is part 4 of the 10 reasons not to buy Indexed Universal Life, or IUL. We are reviewing a Todd Langford article, and we are coming to you live. Probably not, it's recorded actually. We are coming to you live from Hawaii and an undisclosed vacation destination for Charlie Jewett. We are Hawaii, and he is about to turn 5-0, so we are Hawaii 5-0 today.
That's what's up. Undisclosed. It makes me sound so official, right? Makes me sound so official. So those money managers don't find me. Me and my secret security people, Secret Service people, right?
They are hunting you right now.
They are looking for me. That guy that talks bad about the market. Silly.
All right. Well, I'm going to share my screen. So those of you watching video, you're going to be able to see the article we're talking about. For those of you listening at home on a podcast app of your choice, I'll be narrating everything. So you'll have best of both worlds here. So let me switch over to the article, and we're going to recap what we've covered, and we are going to go through the final installment of the 10 reasons, if you're watching the video, the top 10 reasons not to buy equity indexed universal life. And this was written and published almost exactly 10 years ago as we record this. We are recording this in April of 2022. And when you listen to this, Charlie will be another year older, and we will be reviewing this today, almost to the day, 10 years later. And we are not saying that this is an outdated article. As we talked about in our last video, by the way, we've done 3 other videos on this, covering numbers 10 and 9, and then 8 and 7, and then 6, 5, and 4 were grouped together. So those 3 videos you can listen to on this same channel. And we are not saying this is an outdated article. We are saying it was written 10 years ago to be misleading and not factual then. And things have only gotten better on this side since then. So today we're going to recap the 10 reasons, and then we're going to dive into the final 3, 2, and 1 reasons. So number 10. Internal costs are not guaranteed. Mortality charges are not guaranteed as number 9. Number 8, market drops cause double pain. Number 7, late premiums kill any guarantees. Number 6, dividends from the index don't get credited, asterisks. Number 5, participation ratios are often less than 100%, asterisks. Number 4, returns are usually capped at various interest rates, asterisks. Number 3, guarantees are not calculated annually, asterisks. Number 2, all of the above can be changed by the company. And number 1, the risk is shifted back to the insured. So we're going to hop into number 3 right now. I'm going to scroll on down for those watching at home. And we're going to review this one. This is the final asterisk one that I read off. Guaranteed minimum returns are not always calculated annually. EIUL, or Equity Indexed Universal Life Policies, have a guaranteed minimum return so that if the index drops below this rate, the insurance company will still credit at the guaranteed minimum rate. However, with some policies, this guarantee is not applied annually, but instead over the, quote, indexing period, which could be 5 to 10 years. So you have negative years in the index, parentheses, below the guaranteed minimum rate, which would be applied to the side fund. This would cause a further reduction of value in excess of the guaranteed minimum rate in one particular year, and as long as the overall average rate for the entire indexing period is not less than the guaranteed minimum rate, this would still count as meeting the minimum. Jesus.
I know.
All right, so then they give an example. Then they give an example of they're essentially going through the average rate of return or averaging yield conversation. And there's an example here on the video, but this written example is, for example, if the minimum guaranteed rate is 2% inside a 5-year indexing period, you could have crediting rates of plus 13, minus 10, plus 10, minus 8, plus 9, which would validate the promised guarantee because it would average more than 2% per year over the 5 years. The implication is that you cannot have a negative return, but as shown in the example below, you can have a negative return as long as the guarantee is not calculated annually. Okay. So for those seeing this at home, this is an average rate of return conversation, which does not apply to indexed universal life. This applies to variable universal life. And correct me if I'm wrong, Charlie, but that is what this conversation is about.
I guess so, unless he's saying he's discovered inside of index. Like, I'm aware of like the 2% guarantee where they say, let's say the market goes down for 5 years, then you want to cancel a policy. They'll go back and credit it with 2% a year and then take out the surrender penalties. And it's like if something that's never happened happens, you still make some money. You know what I mean? Where if you're in the market and it goes down for 5 years, you're losing money, you know? I don't know if he's called the insurance companies and found that what they're really doing with an index product is looking at even though the negatives aren't, they don't lower your account, they take them into account over the 5 years to see if it made. I don't know what he's talking about. I have the same problem with almost every point, which is you can't write an article top 10 reasons not to eat food. Because then people would go, well, what am I supposed to eat instead, right? It could be like top 10 reasons not to eat meat, and here's why you should eat vegetables. And obviously this company has that. They sell whole life insurance to everybody, right? So you could say top 10 reasons not to buy index universal life insurance and stay in the market, or top 10 reasons not to buy index universal life insurance and buy whole life, which is what they're saying, right? I don't understand why he keeps coming up with scenarios that have never happened and saying this is a negative or a reason not to. We don't have any 5-year periods where the market has gone down for the whole 5 years. You know what I'm saying? In an index, because there's a reset every year. There's a reset. The annual reset protects against that. So I'm leaving myself open to saying he may have discovered something mathematically. I mean, this guarantee is not something we ever pay attention to because the products all make more than the guarantee. The guarantees never had to be used, and people don't cancel policies. They don't walk away. This has to do with, if you want to surrender it or blah, 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 So I don't understand the point. Can you scroll back up so I can see the big, giant, confusing? Sure. And by the way, if you're an industry professional who teaches this and writes books and you read someone's paragraph and go, what is he talking about? It's not a well-written paragraph. How does any consumer understand what he's talking about? I don't get it. So my understanding of the guarantee is if you make zero, if you're here for 5 or 10 years in our product, I'm speaking like the insurance company. If you're here for 5 or 10 years in our product and the market doesn't make any money, we'll go back and credit 2% a year. So if you look at like a waiver of surrender penalty MEC, modified endowment contract, which we used to have at companies like North American or Equitrust had one, blah, 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 Midland. You put $100,000 in, you can always get $100,000 back as a waiver of surrender. There's no surrender penalties. And then you look at the column that says guaranteed, and you can see that if the market didn't go up for 5 years, but you canceled, they credited you 2% a year, and then they took out the cost of insurance. So there's a little earnings. It actually did better than what banks are paying. And that's why we used those products, kind of like a better bank account, right? I don't really know what his point is or how this is number 3 out of 10. Like, it's supposed to be really useful, but if you go back and look at the 5-year periods in the stock market or any index, we don't have 5 down years. We have 2 down years and 3 up years, or 1 down year and 4 up years, or we aren't seeing this. I don't really understand it.
Yeah, and to your point, when I look at this, I I'm probably not being as fair as you are. You're saying he may have discovered something, and quite possibly he may have. But what I see when we talk through this is a variable universal life policy that has positives and negatives and positives and negatives. If you're watching the video, I'm scrolling across the 5-year earnings rate that they had listed here. There's pluses, minuses, pluses, minuses, pluses, and they're saying the average is just like we talk through with average rate of return and how Wall Street talks about your account balance may be less than you started with, but they're going to say they got a positive rate of return because of the average. And we just don't have negative earnings rates because we have a floor of 0. And so these indexed strategies, which we're big fans of, it would be 13, 0, 10, 0, 9, 0. And then using those, we would come out with an average, and that average would be closer to 5, right? If you look at just adding up those same exact numbers. So that's where I look at this, and I think they're talking variable.
Sure looks like it. He's got negative interest earnings, which we don't ever have in an equity index universal life policy, so I'm not sure how this applies.
And that's where I'm giving him less benefit of the doubt, as you are very, very nicely saying. I think he's referring to variable universal life, which is why I don't like this article at all, because you're taking the worst parts of every vehicle and saying that they're all under the same name, and they're not. Because we don't have negative interest earnings, because it all comes back to you have a floor of 0. So I think as confusing as that point was, I think the answer is either he knows something that none of us have learned in the last 10 years since this was written, or he's conflating variable universal life with all universal lives. And that's where I disagree wholeheartedly.
Yeah.
All right. Number 2, let me see what he actually called this one. Number 2 is all of the above can be changed by the company. All of the above can be changed by the company. And what he actually writes here is at the discretion of the company, any of the above factors can be changed at any time for the benefit of the company, even after the policy has started. This is really one of the scariest aspects of all types of universal life. There is no way to calculate what the outcome might be, even if you analyze the policy under the current structure and found it to be a viable tool. Future changes could cause future problems.
So I'll take the guaranteed problems of whole life. Like, just rip me off and charge me 2-3 times as much from day one. E.F. Hutton was wrong. There was no benefit from separating these things and creating flexible premium adjustable life insurance. They must have just had a bad day. Some bad pizza, that whole E.F. Hutton group. The question that advisors should, fiduciaries, real fiduciaries. I don't know if Todd has a Series 65 or he's just an insurance agent. It doesn't matter. I was just an insurance agent for 9 years and I still acted like a fiduciary and told people the truth. You just go study and find the research. Do insurance companies do this is the question. Not can they do it. Bobby, what are the other things in our lives that we somehow managed to survive when they could adjust everything? Cost of groceries, cost of gas, rent, inflation, taxes, how nice your spouse is to you, weather. I mean, everything in the world could change in the future. And then you come up with this product that says, no, we're going to overcharge you from day one and give you something called a dividend, which is just a return of overcharged premiums. We're going to create a ridiculously expensive product that has a history of making 3 to 4%, and then call that guarantee good. And then the product's created after it to fix all those problems because they don't have the same guarantee, because that was one of the problems. We're going to call that bad. How about we just do this? How about we, again, I'll give them the benefit of the doubt and say, this is a difference between universal life and whole life. And it was very purposeful, by the way. It's a difference, not a reason not to buy equity index universal life. It's kind of like when we talk about 401ks. When somebody's investing in a 401k, you really should ask them in the human resources department, do you think taxes are going up or down? Because you do understand that if you use the 401k, you're saying, let me save taxes on this tiny little bit of money, okay, that I put in every month. And then when I take out gigantic chunks, I'll pay whatever tax they want to charge me later. So I want to save tax on the little amount, pay tax on the big amount. And I truly, truly, truly believe that taxes are going to plummet. So I do want to postpone them to later. The person deserves to know the two choices Do you want to pay taxes today on the small amount? Or do you want to pay taxes later on the big amount? And do you think they're going up or down? That's fair. It would just be fair, Bobby, to say, do you want to have guaranteed costs that are exaggeratively high, really, really high, and chew away at your earnings and will drop your income? Or do you want to have costs that aren't guaranteed, that you can keep low by designing it so the corridor is tight between death benefit and cash value, but they could change. The history of insurance companies that they don't change, they don't want to lose you as a customer, but they could change. Let the person choose. Excuse me. We said on the first episode, I'm sick.
So this is where I get a little bothered by this. And so I'll get on my soapbox while you drink some water. And the idea here is that this sentence, this point is a scare tactic. And it comes out like literally says this is really one of the scariest aspects of all types of UL or universal life. And here's where I say this is marketing, right? And so I learned the infinite banking concept first. I learned whole life. I loved it. And when I start asking questions to the whole life world and I say, hey, but can't the dividend change, right? Can't the dividend be reduced or improved, hopefully, by the company specifically when their board meets and they say, hey, we made a lot of money, let's give it back. Can't that dividend change? They all get their cackles up and they say, well, yes, it can, but historically it hasn't, right? Historically it's been XYZ, whoever they're talking about, they'll tell you what it has been historically. And that's where I go back to say, well, can't we give the other types of insurance that same benefit of the doubt? Historically, no company has changed all their fees and screwed all their clients over. Historically, it doesn't make sense to do it. If you did that to your clients, they're not locked in. You can take any product and move it over to another comparable product with a 1035 exchange, just like in real estate, a 1031 exchange. And so if you say, well, the dividend could change, they say, no, historically it's fine. Well, we say, historically, none of this crap's happened. And historically, universal life has performed better than whole life because historically it was designed to. And that's where the benefit of the doubt gets thrown away when you're talking about the competition, and you want to say strictly it's super scary, might cause future problems, it may do this, it might do that, all these potential negatives, and it becomes just scare tactic marketing. And that's where I don't like about this. It really does sling mud for just the sake of slinging mud.
It's an argument not to be married, too. It's an argument not to be married. This is really one of the scariest things about marriage is that after you make the decision, even though you can unwind it, after you make the decision, that person is not guaranteed to be exactly the same for the rest of your life. So don't get married. Top 10 reasons not to be married. It's silly. Silly. Top 10 reasons not to eat food.
Yeah.
Go to grocery stores. They could change the prices. So you're dead on. You're dead on. You're exactly right. In universal life insurance companies, don't control your earnings. They're objective. They're based on a market, right? Going up or down. You get paid whatever the agreement was. In whole life, they're subjective. They decide what to pay you. Costs inside of life insurance policies in universal life are not subjective. They have to go through a process to change their fees and things like that. But one side, they could change their fees. The other side, they could pay you less. What is the difference? I don't understand what the difference is.
Right. No, and that's where it's just, to me, that's marketing. So, all right. So the last point out of all this, and then they get into the more of a sales pitch at the end. But the last point of the top 10 is the risk is shifted back to the insured. Number one reason, the risk is shifted back to the insured. And what they write here is, whereas typically the point of all insurance purchased is to shift the risk from the insured to the company, all types of universal life shift the risk backwards or from the insurance company to the insured. What on earth could they be referring to, Charlie?
I don't think I know. Let me see where it is typically the point of all insurance purchased to shift the risk from the insured to the insurance company. So I pay $100 a month for term insurance. If I die, they pay my family. All types of UL shift the risk backwards or from the insurance company to the insured. I don't know. If I pay $1,000 a month to an IUL or $1,000 a month to whole life and I die, the insurance company's on the hook for it. We get the death benefit. I don't know. Honestly, I don't know. I don't know if he describes it later in the article. I have no idea.
Well, the next paragraph is all about how a mutual life. Well, I'll go ahead and read that as well. So, and then I'll give my 2 cents on that. So, with this, he says. So after he says from the insurance company to the insured, he says with a mutual life insurance company, a whole life policy gives you a share of the entire profits of the company via dividends. The carrot being sold with EIUL is that it might exceed the return of a whole life policy. Yet this begs the question, how could the insurance company pay out more than the profits of the company and still be in business? It has been explained to me that the insurance company buys options in the market to cover the risk of potentially having to credit any portion of high market returns in the index that exceeded their general portfolio rate to policyholder cash values. If this was a sound investment strategy, why wouldn't the insurance company use this strategy in their overall portfolio? I think the insurance company knows that the stock market is going to underperform their portfolio rate over time. This could reduce EIUL profits and increase the profits of the company, which then get distributed as dividends to whole life policy owners. As a whole life policy owner, I should be pleased with EIUL could contribute additional profits to the company, which might increase dividends to whole life. My concern is that EIUL policies are going to create a detrimental effect on the life insurance industry as a whole. I believe this may be the next major blight on the industry since underfunded universal life is so heavily promoted in the 80s. The unfortunate outcome is that any negative media affects the entire industry because the media doesn't differentiate between the new faulty products and the old tried and true whole life products that have been around for close to 200 years. As we know, the biggest danger with the negative press is that it causes panic and people will think the entire life insurance industry is bad, and many perfectly structured whole life policies could get canceled to the detriment of the policyholder and their family, just like what happened in the 1980s. Remember, number 2 above, since the insurance company has the ability to change 10 through 3, they can always keep the universal life policies from outperforming their portfolio, which I want to take the safe portion of my assets and the protection of my family and expose it to risk. Doesn't that defeat the whole purpose of life insurance? In my mind, I buy insurance and shift the risk to the insurance company because they are the experts at mitigating risk and storing cash to support it. If you seriously are considering purchasing an EIUL product, please make sure you read and understand all the risks you and your family are assuming. Because of the complexity and numerous moving parts of this product, many people are selling it that I've spoken with don't even understand it themselves. For me, I prefer a number of simple, guaranteed, tried and true whole life policies. These protect my human life value and store my cash in an efficient manner. Wow.
Can you point to the name of the website that this article is on, please? The URL? With your cursor?
This website is the infinitebanking.org, and he posted this also on truthconcepts.com.
So let me just review what infinite banking is for the listener. Infinite banking is a teaching that says if you overfund life insurance, a permanent life insurance policy, if you put more money in than you need to pay for the death benefit, the insurance company will invest it in some manner. Whole life, it's in dividends. Index universal life, it's in, it's really, they're buying options on an index. There could be other things, but that the extra above and beyond goes and grows. The insurance premiums come out, that disappears. The extra is what grows and becomes a pile of cash. And in the infinite banking world, they teach you borrow from yourself instead of borrowing from credit cards, instead of borrowing from auto loan companies. If you have enough money in there, you could do it instead of mortgages, whatever. You have to accumulate the cash for it to be infinite banking, Bobby. And it feels like this article is written like why to buy whole life if you're going to minimum fund for life insurance. There's even language we just read towards the bottom that like what life insurance is for. But that's not what it's for in infinite banking. That's not what it's for in retirement planning. That's not what it's for since the late 70s, early 80s when index universal life insurance was created for tax-free policy loans during retirement. Or it's a weird thing to do. Maybe he wrote it. Maybe someone put this article on the Infinite Banking website, and he wrote it to say why you should buy whole life and monthly funded at a minimum instead of, index universal life. That would make more sense to me, right? But it shouldn't be on a website called infinitebanking.org, because this has nothing. Right. These points have nothing to do with infinite banking.
No, you're right. And I think I'll scroll down to the bottom here for those watching the video. And this is where I feel like they're conflating all aspects of anything that's not whole life together. So he didn't even do the research itself. It sounds like it has been explained to me that insurance companies buy options in the market to cover the risk of potentially having to credit any portion of the market returns in the index than their general portfolio when it outperforms. Why wouldn't they use this in their overall portfolio on their own? The answer is they do. They do use this in their own strategies. And they are simply allowing us to participate in their own strategies. So what he is describing here, if unless I'm misreading it, what he is describing here is a whole life company that is offering an indexed universal life policy. And those are very rare and very specific. The reason for that is most companies that offer indexed universal life policies. Now, there are some whole life companies that do, but most companies that offer whole life and indexed universal life are regulated differently. One of them is a mutual company, and a mutual company is mostly whole life, and the dividend that they decide to pay back comes from that company. And that whole life mutual company creating an equity indexed universal life product is doing so to meet market demand, not actually optimizing a tool that's going to make amazing returns. I can't think of one, maybe you can, Charlie, that is a whole life IUL product that actually performs better than some of these non-whole life companies. I know we have some great companies we work with, but I don't think any of them sell whole life. Do you?
No, I don't think so.
Yeah, so the ones that I have seen and researched that are whole life companies that specialize in whole life, which they do great doing that, when they try to create an index universal life policy, it does not have the same bells and whistles and things because they are subject exactly like he says, but it's actually a pro when it's not a whole life. It's a con when it is a whole life. They are subject to the performance of the general fund and what that board says they want to pay back in dividends. So if an IUL policy performs amazingly well, he's exactly right. It adds to the coffers, and whole life policies should get bigger dividends. But that's only the case when a whole life company creates an IUL product. That is not the case in most IUL products. So it's a very niche example, and I only recognize it because I learned that side first, where you're talking about a company that specializes in one thing, branching out because of market demand, creating a product that may or may not be better long-term, and then trying to sell it. And therefore, yes, there could be bad press associated. People may not understand them, all the moving parts, but that is not an indication as to why you should trust that same company to go and buy your whole life policy from. Because now they're trying to put their irons in too many fires.
Yeah. I don't even know what to say, buddy. This is the second time I've been through these 10 points. Second time I've been through these 10 points, and they're kind of, they don't make any sense to me. I wish they were better articulated. I wish it was a good debate. And the reality is, I think Todd was wrong. I think he's talking about things that aren't actually negatives, and he actually got a lot of it wrong. And then when I offered to have him come on and show me what he meant, he said no. So I don't know where to go from that. But the listener, the person listening, my experience over an 18-year period as the person that no insurance agent will debate right now, I can't find anybody in the country who will debate me on any of these topics, no matter who I ask, as that guy who's done thousands of these and called all the insurance companies and asked them questions, I cannot find a shred of evidence that any of this is true, and I can't find a single whole life agent in the country who can create an illustration or argue that whole life will beat an index universal life strategy or an index universal life policy. And we have the article, the third-party article that shows that whole life companies lie on their illustrations and then they pay less over 20-year periods. And we have the current laws that show that on an index universal life insurance illustration, we are not allowed to show you what they've actually earned over the last 10, 20 years. We have to dumb it down, and we can't use real loan rates. When you go to borrow from them, you can't use actual loan rates. You have to exaggerate them up. And the illustration, when we dumb it down and exaggerate the costs, so lower returns, higher cost, still beats the whole life, which is exaggerating the returns. Find someone in the country to debate me, and let's have the conversation. But if that's probably not going to happen, by the way. I've been trying this for 6 years. For you, the consumer, every decision is easy when you see clearly. Have an illustration for both. We can do the one for the index universal life because we have to build it a certain way. There's almost nobody in the country that does it right. We've got to design it and then lay it side by side with the internal rate of return and the policy charges and expenses report side by side. Apples to apples is always easy, Bobby.
Absolutely. And I'm going to, just to recap all 10 points with the takeaways, right? Not to go through all the points again, Charlie. I know you don't want to go through that. The takeaways are apples to apples is using an internal rate of return comparison. Number one. So have them run that, have us run the other one. That's fine. Have any agent in the country run an internal rate of return and the policy charge page. Every policy comes with this. It's all built in. There are no variables that we don't know about. They plan these out ahead of time because they are good at mitigating risk. So comparing this apples to apples, you need those to actually look at them side by side. Additionally, most agents, and so everybody can say this about each product, there are ways to build them poorly. And so people on our team, people in our companies that work with us know how to build them correctly. We spend a lot of time making sure they build them correctly. And so by reducing fees, improving the cash, they become amazing products. And we will compare them apples to apples. We call it good news or good news review. And we'll make sure we have that third-party study. We have some other illustrations that we have referenced. We'll make sure they're in the blog posts. But anything else you want to add before we wrap this up, Charlie?
No, just can you tell that you're further west than me as the sun is setting on me and not you?
That's right.
No, this is good. I mean, I'm
Hawaii right now.
I'm the same as I was when I started in 2016. Let's get the truth out there. Just what we get paid the same commissions on whatever life insurance. Mm-hmm. There's no reason for us to not like whole life. You know what I mean? Just like variable annuities. I don't sell variable annuities because I can't find anything about them that's good. They just have these high fees for being in the market when you can be in the market without the fees. They don't do what annuities we want. Same thing with whole life. It has the taxation of insurance and then has high fees and low returns. Well, I want the taxation of insurance, taxed like a Roth IRA, with low fees and high returns. And we can do it in index universal life. If it's not true, let's just look at it. Somebody come and show it to me and let's see if show me I'm wrong.
That's it. All right. Well, I'm Bobby Alford. He's Charlie Jewett. This has been the series of 10 reasons not to buy an index universal life policy. And mahalo. We will talk to you soon.
Thanks so much for listening to Renovating Retirement. We hope you enjoyed the episode. If you have time, please subscribe to the podcast and consider rating and reviewing the show. That will help others find us. And for show notes, resources mentioned, and to connect, head on over to renovatingretirement.com. Thanks again for listening, and we'll catch you next time on Renovating Retirement.